Hi, welcome back to Joe Blogs. In today's episode, I want to provide you with an update as to what's happening in China. If you've been following the channel, you'll know that China has been going through a slump recently, and the forecast GDP for 2023 has been revised downwards to around 5% growth. And new data is constantly being received in terms of all of the different metrics. And in today's video, I'm going to give you an update on what's going on in the property sector. We've got some figures with regards to property investment, which are negative, and also what's happening with sales year on year and new home prices. We'll also talk about a new report that's been published by Moody's, where they've downgraded the Chinese property sector, and also a report from Fitch, one of the other rating agencies, where they've actually now reduced the GDP forecast for 2023. We'll then go on to talk about some more data that's come out with regards to industrial output and retail sales, which actually show a glimmer of hope in terms of the performance of the economy. However, as with any statistics, you need to look at the big picture. So we'll also have a look at what's been happening to exports and imports in August. We'll then have a look at what's going on with inflation, and then we'll go on to talk about electric vehicles, because the European Union have just announced that they are looking to investigate the Chinese electric vehicle market because they believe that the Chinese authorities are providing subsidies to Chinese electric vehicle manufacturers to enable them to offer their cars at significantly lower prices than the European market can actually produce cars for. So we've got a real disconnect at the moment between the two markets. And the head of the European Union has accused the Chinese car industry of flooding Europe with cheap electric vehicles. Now, as you might expect, China have pushed back on this issue, and this is brewing up to be an exact rerun of what happened with solar panels back in 2012 when the European Union accused China of flooding the market with cheap solar panels. So I'll have a look at exactly what's going on in the electric vehicle market, and there are some major players that are coming out of China now. China was not renowned for producing traditional cars. However, as China has been investing heavily into the production of batteries for electric vehicles, and also there are some major plants for companies like Tesla and Volkswagen in China, it's built up its expertise. And because the Chinese car market is by far the biggest market in the world, the Chinese electric vehicle manufacturers are now gearing themselves up to take on all of the majors all across the globe. And then finally today I'll wrap up with my summary as to what I think is likely to happen in the Chinese economy over the course of the next 3 to 6 months, and what the impact of that will be on the global economy. But before we get started on all of that, I'd like to say thank you so much for all the really positive messages of support that I've received recently about returning to the studio. It does feel great to be back on camera. It enables me to maybe speak a bit more off the cuff and say a few more things that I wasn't saying when we were looking at footage. So hopefully you're enjoying those comments. And if you'd like to see more off-the-cuff chat and face-to-face videos, then please check out my Patreon channel, because I'm posting a lot of content on there that isn't going onto YouTube. These are shorter videos, me just talking about things that are happening generally in the economy right now. I'll give you the heads up on what videos I'm currently working on. You'll get early access and be able to watch the videos without any annoying adverts. And if you'd like to propose some topics for future videos, you can also contact me through Patreon. However, if you don't like Patreon, and I know there's a lot of people out there that don't, and you'd like to support the channel, then please have a look below where you'll find links to buy me a coffee and YouTube's super thanks and membership. The once mighty property sector still remains a drag on China's $18 trillion economy, with the country's largest private developer, Country Garden, the latest to stumble due to a liquidity squeeze. And the latest industry figures provide little comfort for policymakers and investors. In August, property investment extended its fall, down 19.1% year on year, from a slump of 17.8% in July. Additional data shows weak investor confidence, with private investment shrinking 0.7% in the first 8 months of 2023, deepening the contraction from 0.5% in the period between January to July. Now, as you'll be aware if you follow the channel, the housing market in China is unlike most in the world and is focused predominantly on new house sales rather than second-hand sales. And this chart shows the movement in newly built house prices over the course of the last 12 months. And as you can see from this chart, there has been a year-on-year decline in new house prices in 10 out of the last 12 months. In June 2023, prices were completely flat, and the only month when there's been an increase in prices was May, when there was a 0.1% increase. And if we look at the latest figures for August 2023, there was an additional 0.1% decline in new house prices. And as a result of the major problems that are going on in the Chinese property sector at the moment, Moody's, the rating agency, has revised its outlook for China's property sector from stable to negative, despite the introduction of a variety of stimulus measures by the Chinese regulatory authorities to boost home sales and prop up the falling property market. The report listed China's weaker economic growth prospects and continued by concerns over timely project completion and delivery as the main factors contributing to the negative outlook. A Moody's spokesman said, "We expect nationwide contracted sales to fall around 5% over the next 6 to 12 months, driven by a decrease in volume as home buyers' concerns continue. Credit stress at Country Garden Holdings has also amplified buyers' risk aversion." The agency expects the impact of China's latest stimulus measures, including reduced mortgage rates and down payments, to unevenly affect higher and lower tier cities, with the latter expected to face further sales declines due to continued population outflows. Sales in first and second tier cities, on the other hand, will be more resilient. However, the boost from policy support is likely to be short-lived, as China's economic recovery still faces a host of challenges, ranging from low consumer confidence and high local government debt to high youth unemployment. Moody's also pointed out the gap in credit quality between state-owned and privately owned property developers could grow further over the next 12 months, as home buyers and investors now want to avoid entrusting their money with debt-laden private developers, which are also facing difficulties in accessing funding. Alongside the change in Moody's outlook, Fitch, the rating agency, has cut its forecast for growth for China's GDP for 2023 by 0.8 percentage points to 4.8%, and this compares to a 0.1 percentage cut for the global economy as a whole. Fitch's latest report states the previously hoped-for stabilisation in China's housing market has failed to materialise, and new sales could fall by a fifth this year. Housing is a third of investment and 12% of Chinese GDP, and has strong multiplier impacts on the wider economy. Policy easing has been underwhelming to date, and export demand is falling. The report went on to state that nationwide property sales have dropped around 20% year on year in June and July, reversing growth of 11.9% in the first 5 months, and reflecting renewed weakness in the residential property market. This chart shows the percentage movements in Chinese industrial production over the course of the last 12 months. And what this shows is that industrial output in China has been very erratic over the last year. In September 2022, China saw 6.3% growth. However, in October, November and December, industrial output fell. And by the end of December, the year-on-year growth was only 1.3%. And at that stage, economists have been predicting GDP growth for China for 2023 of between 6 and 7%. So this was seriously off track. Now, there was some recovery in the first 4 months of 2023, and by the end of April, the year-on-year growth in industrial production was up to 5.6%. However, that recovery was short-lived, and in May, industrial output growth contracted to 3.5%. It increased to 4.4% in June, fell back to 3.7% in July, and in August 2023, it's now sitting at 4.5%, which is still below the reforecasted GDP growth for 2023 of 5%. Now, I think this chart is really interesting because you could read into it in a number of different ways. If you were just to look at the movement between July and August, you would say the 0.8% increase is a very positive trend and is moving China back towards where it wants to be of 5% growth for the rest of this year. However, when you look at what's been happening over the course of the last 6 months, you can see that there have been peaks and troughs in terms of the performance. And if you were to look at what happened between March and April, when industrial output rose from 3.9% to 5.6%, you could have got very excited at that point and said, this is the turning point for China, they're now back on track, and potentially they may achieve above 5% growth for the rest of 2023. However, in May, industrial output actually fell back down to 3.5%. So what this tells us is that you can't base your analysis and assumptions into 1 month's performance. You need to look at the overall trend. And if you look at the period between January 23 and August 23, there is an upward trend, so we're seeing an improvement in the performance of China. But the big question is, will China hit 5% growth for 2023? And the answer to that question at the moment is we don't really know, because every single month the performance is all over the place. And then when you take a step back and look at everything else that's going on, look at what's happening with exports and imports and the property sector, then you have to take a balanced view and say that it is still very challenging for China to be able to hit that 5% target. Now, this chart shows the movement in China's retail sales over the course of the last 12 months. And if we zoom in and have a look at what's happened in August 2023, you can see that there's been a 4.6% increase in retail sales. So at face value, this represents positive news for China, because we've got an increase from 2.5% in July to 4.6% in August. So this is moving China along the road of trying to achieve its 5% growth target for 2023. However, as we just discussed in terms of industrial output, you need to look at the bigger picture here. And if we look at what's been happening during the course of 2023, we had low levels of growth in January and February. We then saw a huge increase in March, April and May, and we were into double-digit territory. And at that point, a lot of commentators were getting excited and saying that China had turned the corner and things potentially were going to look good for the rest of this year. However, we then saw the year-on-year figures slump in June and July, and we're now seeing an element of recovery in August. However, the figure of 4.6% is still below the 5% target growth rate for China for the rest of this year. And it won't really be until we see the figures for the next few months that we'll know whether or not China has managed to turn the corner and improve its retail sales on a longer term basis, or whether this was just a short-term spike. This chart shows the percentage movement year on year in China's exports over the course of the last 12 months. And the scale on the right-hand side of this chart ranges from positive 15% growth at the top to negative 15% growth at the bottom. And the overriding message coming out of this chart is that in 9 of the last 12 months, China has seen a year-on-year fall in its exports. And for a country that is based on exports, that is the main driver of the Chinese economy, this represents a disaster. And you can see that over the course of the last 11 months, there have only been 2 months with positive growth, being March and April. And the reason for that positive growth was predominantly the fact that China removed all of its COVID-19 restrictions at the end of 2022. Up until that point, it was still putting whole cities into lockdown if 1 or 2 cases of COVID-19 were discovered. However, the Chinese authorities realised that this was suppressing growth in their economy. They removed the restrictions, and everybody expected that China would be a roaring success for the rest of 2023. And we saw an initial bounce back in March and April. However, that bounce back was very short-lived. And as you can see, in May, exports fell by 7%. In June, they fell by more than 12%. In July, there was a fall of almost 15%. And in August, we've seen a fall of 8.8%. Now, if you're looking for a glimmer of hope in terms of what's happening, you could say that there's been an improvement in August compared to what was happening in July. But a year-on-year decline of almost 9% doesn't represent good business from China's point of view. And so in order for China to be able to turn this around and hit 5% growth, lots of really amazing things will need to happen over the course of the next 4 months. This chart shows the year-on-year movement in imports for China over the last 12 months. And the scale on the right-hand side of this chart goes from 5% positive at the top to 25% negative at the bottom. And once again, the overriding summary of this chart is that over the last year, China has seen a year-on-year fall in its imports. And in fact, there have only been 2 months out of the last 12 where there's been any signs of growth. And that positive growth was minimal, 0.2% in September 2022 and around 4% in February 2023. In every one of the other 10 months, we have seen year-on-year falls in imports. And in many of those months, it has been a significant fall. In January 2023, imports were down by more than 21%. And in May, June and July, imports fell by 5%, 7% and 12%. And the figures for August show that imports are down by 7.3%. Now, in the same vein as what we talked about for exports, there is a glimmer of hope for China here, because the month-on-month figures have improved between July and August. However, the 7.3% fall in August once again represents a serious shortfall against a projected growth for 2023 of 5%. And of course, the reason that imports are so important is that China, despite the fact of it being a net exporter, has to buy in lots of raw materials and fuel to be able to feed its manufacturing machine. It doesn't have everything on hand to be able to make things itself. So when the level of imports is falling, that tells us that the purchasing managers are buying in less raw materials and fuel because they're not expecting a major ramp up in terms of their production. So the level of imports really gives us advance notice as to what's likely to happen to exports. So the fact that we're still seeing a fall in imports tells us that it's very unlikely that the exports are going to take off in the last 4 months of 2023. This chart shows the official rate of inflation for China over the course of the last 12 months. And if you've been following the channel, you'll know that I previously posted a video talking about the results for July when China experienced deflation. So you can see that in the month, the year-on-year movement in prices was a fall of 0.3%. Now, as you can see, the figures for August show that China has actually managed to reverse that position. And over the course of the last 12 months, prices have now increased by 0.1%, which is good news from China's point of view, because they are trying to desperately avoid going into a prolonged period of deflation. That's exactly what happened to Japan over the course of the last 20 years. They've really struggled with deflation. And the problem with deflation is that it's very difficult to be able to absorb any cost increases. So if you're buying in things from overseas that are going up in price, you can't pass on those increases in cost into your prices because you've got falling prices in your home market. And also, it's very difficult to be able to pay anybody any pay increases, because if you're selling your goods for less than you were selling this time last year, then the only way that you can give people wage increases is by cutting your own profits. And no company wants to do that voluntarily. So it's good that China has moved away from deflation, but 0.1% growth is still problematic for all of the same reasons, that if you've got an increase in costs of 2 or 3%, then you can't pass that on with a 0.1% increase in prices. And equally, in terms of wage increases, nobody wants a 0.1% wage increase. So this is still an ongoing problem for China. And as we discussed in the other sections, you can't really base your analysis on what happens in 1 month. You need to look at the trend. And the trend since the beginning of 2023 is significantly downwards. There is a reduction in terms of the level of growth in prices in China over that period. And it will be fascinating to see what happens over the course of the next 3 or 4 months, whether or not we start to see prices going up again, or if the August figures were just a blip and we continue to see deflation causing major problems in the Chinese economy. This chart shows the largest markets in the world for new vehicle sales in 2022. And as you can see, China is by far the largest market in the world, selling over 23.5 million new cars in 2022, followed by the United States at 13.7 million, Japan at 4.2, India 3.8, Germany 2.6, Brazil 2 million, South Korea 1.7, United Kingdom just over 1.6, France just under 1.6, and Canada 1.5. And interestingly, the biggest brands in China in 2022 were Volkswagen and Toyota, both of whom sold 2.2 million vehicles, and Honda, who sold 1.4 million. However, things are changing rapidly, and Chinese manufacturers are now major players in the world of electric vehicles, and electric vehicles are growing rapidly. This chart shows the cumulative number of battery electric vehicles and plug-in hybrid vehicles exported from China dating back to 2018. And what this shows is that in every single one of the last 6 years, there has been an increase in the number of electric vehicles being exported from China. In 2022, the total was just over 1 million vehicles. However, in the first 7 months of 2023, China is up to 900,000 vehicles, and it's estimated that there will be a significant increase in the full year. And one of the accusations being made against China is that the Chinese authorities are now providing significant subsidies to help Chinese electric vehicle manufacturers gain more sales overseas.
The EU and China could be on course for a fallout over electric vehicles. The European Commission announced Wednesday it will investigate whether to impose tariffs to protect the bloc's producers against cheaper Chinese EVs. Commission President Ursula von der Leyen.
So I can announce today that the Commission is launching an anti-subsidy investigation into electric vehicles coming from China.
It argues China's car makers are benefiting from state subsidies. The Commission will have up to 13 months to assess whether to impose tariffs above the standard 10% EU rates for cars.
Global markets are now flooded with cheaper Chinese electric cars. And their price is kept artificially low by huge state subsidies. This is distorting our market. And as we do not accept this distortion from the inside in our market, we do not accept this from the outside.
The investigation covers battery-powered cars from China, so it will also include non-Chinese brands made there like Tesla, Renault and BMW. European car makers face a tough task to break China's lead in developing cheaper EVs. Chinese EV makers like BYD have stepped up efforts to expand overseas as competition intensifies at home and domestic growth eases. Industry data show China's auto exports surged 31% in August, following a 63% jump in July. The average price of a Chinese brand electric car in Germany was 29% lower than the average for non-Chinese EV models, according to a leading automotive analysis group. They're also 32% lower in France and 38% in the UK. Tensions between China and the EU have been growing, partly due to Beijing's closer ties with Moscow after Russia's invasion of Ukraine. And the EU wants to lower its reliance on the world's number 2 economy.
So what's the summary and conclusion today? Well, I wanted to post this video really to give you the latest data that's been released on the Chinese economy. And as we've seen, the property sector, which accounts for around 25% of total GDP for China, is still suffering very badly. The latest data we've seen in terms of property investment shows that there's been another contraction in terms of investment into the sector. And obviously that will have long-term implications, because for this sector to be able to turn around, it needs investment. It needs the millions of unfinished apartments that are currently spread all across China to be completed and handed over to their buyers. And it also needs a complete change of sentiment in terms of buyer confidence. Over the course of the last 18 months, Chinese buyers have gone from being hugely bullish and wanting to queue around the block and buy as many properties as possible to being completely bearish. And everybody now in China is very cautious about what's happening in the sector, because for the first time in a generation, prices are no longer going up. This isn't the no-risk gamble that it was 2 or 3 years ago. And the major property developers that have grown up over the course of the last 10 to 20 years are now struggling because they've had their debt supply cut off by the authorities. And until that situation gets rectified, these monumental companies will not be in a position to be able to carry on with their building programs. And over the course of the last couple of months, we've seen China's largest property developer, Country Garden, actually getting to the point where it was due to default on its debt, and it's had to sit down and renegotiate all of its facilities. So the sector is still in dire straits. And because it accounts for such a big part of China's GDP, it's having a ripple effect all the way through the economy. And as we saw earlier in the video, Moody's, the rating agency, has now downgraded the sector, and Fitch have also downgraded the forecast GDP for 2023. So the outlook at the moment is still very negative. And as we saw from the trade data, there are still major concerns about Chinese industry. Exports were down significantly in August, as were imports, which tells us that it's going to take some time for China to be able to turn this around, because China is importing a lot of raw materials which it then uses in its manufacturing process. There is a glimmer of hope in terms of the improvements in industrial output and retail sales. However, the percentage improvements in the month of August are still below the 5% full-year growth forecast for the Chinese economy. So there is still a major question mark as to whether or not China will be able to hit that 5% target. Now, one of the bright spots in terms of the Chinese economy and also its global exports is electric vehicles. And over the course of the last few years, we have seen a huge growth in both the number of Chinese electric vehicle manufacturers and also their global presence. They're now starting to gain traction in lots of markets all around the world. And one of the most attractive things about Chinese electric vehicles is that they offer good value. They are cheap compared to local competition. And as we saw earlier in the video, the European Union has now held up a red flag and said that they don't believe that the prices that the Chinese electric vehicle manufacturers are offering are fair and competitive. They believe that the Chinese authorities are providing subsidies to enable those companies to offer their vehicles below market price. And as a result of that, the European Union has now started an investigation. Now, it will be interesting to see what that investigation throws up, because as I mentioned right at the start of the video, in 2012, the European Union invested the Chinese solar panel manufacturers. And the outcome of that investigation was that the European Union believed that the Chinese authorities were subsidizing the solar panels. And so they decided that they were going to impose tariffs of up to 65% for Chinese imports. However, China was not impressed with that proposal, and they threatened a trade war and said that they were going to start applying huge tariffs to European imports into China. And as a result of that, the European Union decided to back down, because the last thing that they wanted to do was get involved in a trade war with China. So the European Union is now going through the same process for electric vehicles, and it may be that they decide in a year's time that China is subsidizing electric vehicle manufacturers. However, what are the European Union going to do about it? Because if they decide that they're going to impose large tariffs, it's extremely likely that China is going to come back and say, okay, if you're putting tariffs onto our exports, we're going to start putting tariffs onto European imports into China. And it's likely that the European Union is going to find itself in exactly the same position as it was 10 years ago. And in the meantime, I'm sure the Chinese car manufacturers will be continuing to sell their vehicles at prices that are very attractive to buyers in Europe. But the overall summary of today's video is that there are still major problems in the Chinese economy. The property sector, which represents around 25% of total GDP, is still on its knees, and it looks very unlikely that that is going to turn around at any point in the near future. The large property developers are experiencing major problems in terms of accessing capital to be able to finish the builds, and the consumers in China have completely lost confidence in the market. So that part of the Chinese economy isn't likely to recover anytime soon. In terms of what's going on with trade, there are a couple of glimmers of hope in terms of the industrial output and retail sales for the August figures. However, the figures for exports and imports for August are down significantly year on year, and that's by far the largest chunk in China's trading. So there are still major concerns and major problems, and it's likely that over the course of the next 3 to 6 months, China is going to struggle to achieve the 5% growth that's being forecast for 2023. We've already seen Fitch downgrading its forecast for GDP, and it's very possible that over the course of the next 3 to 6 months, we could see further downgrades. So that's obviously bad news for the Chinese economy. But as I've mentioned on previous videos, China is the second largest economy in the world. So when China goes into slowdown, it's going to have a direct impact on the global economy, because China doesn't just export things, it's importing lots of things. So it's buying things from lots of countries. And when it starts buying less, that means that those countries are selling less, and therefore their GDP will go down. So if China does see a continued slowdown over the next 3 to 6 months, that will cause a further slowdown for the global economy, which is obviously bad news for all of us. And as I mentioned in a recent video, normally you would expect a global slowdown to lead to a reduction in oil prices, which would help alleviate that slowdown because it would reduce everybody's costs. But what we're seeing right now is that OPEC Plus, which represents around 50% of the global supply of oil, are actually reducing their supply deliberately to push prices up. And we've seen oil prices rise above $90 per barrel. And that actually represents a big threat to the global economy, because at times of slowdown, you want to be able to cut your costs. But what's happening with oil, which is one of the major costs for everybody, is that oil prices are going up at a time when everybody's income is going down. And that's going to be a vicious circle for countries that are net importers of oil. So as always, I'll keep you posted on what's happening in the Chinese economy as soon as any more data is released. But hopefully you found today's video useful, informative and thought-provoking. If you've liked what I said, then please give me a thumbs up. Thank you for watching this video all the way through to the end. And here's something to put a smile on your face.